Welcome to Fintech's Fair Play, where we bring you in-depth analysis on the latest and most significant events in the world of fintech. Today we're examining a recent enforcement action by the United Kingdom's Financial Conduct Authority, or FCA, which has issued a substantial fine to Metro Bank for serious lapses in its anti-money laundering protections. Let's break down what happened, the implications for Metro Bank, and what this fine means for the broader fintech and banking landscape. The FCA recently announced that Metro Bank must pay £16.7 million, approximately $21 million, after it failed to adequately monitor money laundering risks across more than 60 million transactions over a 4-year period, from 2016 to 2020. According to the FCA, Metro Bank's failure to implement robust anti-money laundering protections created a significant gap in the defenses against criminal misuse of the financial system. Therese Chambers, the FCA's Joint Executive Director of Enforcement and Market Oversight, emphasized that these failures persisted for far too long and posed substantial risks. The core issue dates back to June 2016, when Metro Bank attempted to automate its transaction monitoring system to detect potential financial crime. Unfortunately, the system encountered a critical flaw due to an error in how data was entered. As a result, transactions conducted on the very day an account was opened, as well as subsequent transactions until the account record was updated, went unmonitored. Despite concerns raised by Metro Bank's staff in 2017 and 2018, the issue remained unresolved. A solution was identified in July 2019, but it wasn't until December 2020 that Metro Bank could ensure that relevant transactions were consistently monitored. During this period, large volumes of potentially suspicious activities might have slipped through the cracks, with no monitoring in place to flag them for review. In response to the fine, Metro Bank issued a public statement acknowledging the FCA's findings and highlighting its full cooperation with the investigation. Daniel Frumkin, Metro Bank's CEO, expressed that the conclusion of these inquiries allows the bank to move forward and focus on future growth, building on the foundation it has since established. According to Metro Bank, significant improvements have been made to its transaction monitoring systems since 2020, aiming to prevent similar issues from recurring. This fine against Metro Bank is part of a broader trend of increasing regulatory scrutiny on anti-money laundering, or AML, efforts within the financial services industry. Just last month, TD Bank in the United States was hit with a massive $3 billion penalty due to its own AML deficiencies. Around the same time, the FCA fined Starling Bank an even higher amount, £29 million, for what it described as shockingly inadequate financial crime controls. So what does this mean for Metro Bank and other financial institutions? Regulatory bodies like the FCA are making it clear that non-compliance with AML laws and regulations will result in severe consequences. For banks, fintech companies, and payment service providers, robust AML compliance isn't just a regulatory requirement. It's a critical part of maintaining consumer trust and ensuring financial system integrity. As we look forward, it's likely that regulatory pressures around AML compliance will only intensify. Financial institutions will need to invest more in technology and internal oversight to meet these evolving standards, and those that don't will face hefty fines and damage to their reputations. That wraps up our analysis of the FCA's recent $21 million fine against Metro Bank. If you found this breakdown helpful, please like this video, subscribe to our channel, and hit the notification bell to stay updated on the latest fintech developments. Thanks for watching Fintech's Fair Play, where we provide expert insights into the evolving world of finance and technology. Until next time.